So Ofmist Sovereign Debt Institute's inaugural survey of public sector borrowers, which features 33 sovereign, supranational and agency respondents globally. The aim is to provide a perspective into the expectations and concerns of SSAs in the market. And also the focus is that we have, as I explained, on demand and liquidity, on investor relationships, on GSS issuance and the role of banks and their issuers and the relationship therein. On to the next slide with some of the findings. What are issuers worried about? This survey took place between the 6th of December and the 6th of January. So at the end, mostly at the tail end of last year. Biggest concern is reduced demand from investors. If you look at the markets this month, maybe things have changed. We'll discuss that over the next couple of hours. But a concern certainly about reduced demand from investors. Higher new issue concessions. We're seeing that in some of the deals now, albeit to very large order books. Lack of clear issuance windows. Window seems to be wide open right now, but will it remain so over the course of the rest of the year? Interesting to note that if you take the top two concerns, then second on the list after reduced demand from investors are liquidity concerns. That'll be a big focus of our topic today. And there's certainly a lot of competing supply out there in the market right now. Next slide, please. So whether this now holds true, given the fast start to the year in January, we will see. But you would all know, I'm sure people joining us today, that in a standard year, you might expect sovereigns, supranationals and agencies to issue 60 or 70% of their annual funding requirement in the first half of the year. At the time of our survey, interesting to see that more than half of our respondents, and I should point out that a third of the respondents in this survey were emerging market and smaller issuers rather than just the big sovereigns and supranationals, saying that less than 50% of their issuance will be done by the end of the first half of this year. So whether that holds true today, we will see, but it suggests maybe that issuers are concerned that market conditions will deteriorate over the course of the year, or perhaps they might want to be waiting for better conditions in the second half. We'll see. Next slide, please. Order books are likely to shrink. This is a finding from here. What do you expect the average subscription ratios for syndications to be in 2023? Over the course of the year, we're not seeing the kind of inflated order books that have categorized some of the markets over the last 2 or 3 years, or even what we've seen this month. So around 40% saying that books would only be 1 to 2 times covered. Next slide, please. Greater emphasis on investor relations. No surprise if your biggest concern is worries about demand from investors. We'll certainly hear from our investors today on what they want in terms of communications with these important borrowers. 75% of borrowers saying they're deepen relationships with existing investors as a primary focus. 64% saying they're going to increase their investor relations efforts in the light of difficult markets and the reduction of central bank net purchases. And a good group saying that in reaching out to new investors will be an important part of their strategy over the course of 2023. Next slide, please. Issuers think they're going to pay more. Marginally more in most cases, although some think they'll be substantially higher, but the majority think they will, it's around 60% that think that new issue premiums will be slightly larger in the markets in 2023. Very few think they'll be lower. A good group think they'll remain the same, but the majority think that new issue premiums will be marginally higher than last year. Next slide, please. We're going to focus, as I say, on the role of primary dealers and the relationship between primary dealers and their issuers over the course of the first part of our discussion. It's a topic that comes up constantly in discussions that we have in the Sovereign Debt Institute, often behind closed doors. We hope to bring some light to the conversation today with the survey results as well, and build a constructive dialogue on what's an important topic, not just for the issuers and their intermediaries, but also for the investors in the room today as well. So we can see here that 45% of issuers are thinking that providing more incentives to primary dealers is a great way to solve a problem that will also come up today, lack of liquidity in the market. Making more use of the repo market also. Interesting to see that it's more incentives to primary dealers rather than easy market making obligations that most issuers are focused on. Other tended to be something around sort of like repo or taps and various things like that. So next slide, please. So 40% of issuers that we surveyed say they already provide incentive schemes to their primary dealers. Around 35% say they're not going to do that. But more than 20% certainly are considering bringing in more incentives to primary dealers to be more active participants in the primary markets, and also, I guess, in the secondary markets as well, where primary dealers play an important role. So interesting that there's certainly an openness to a conversation about this subject. Next slide, please. So have primary dealers been going to their issuers to complain about this, or to express their concerns, shall we say? Well, around 30% of issuers say that they have, and clearly the results of the survey say they're listening. So 70% say they haven't. Well, maybe they haven't directly, but certainly it is a conversation that comes up with primary dealers and issuers, for that matter, privately all the time. So so we will explore ways over the next hour and a half or so how those conflicting concerns may be met in the middle. Next slide, please. Obviously, always in the debt space, a big interest in GSS bonds. We can see here that GSS issuance is becoming embedded and a core part of many issuers' annual funding requirements. Even those that are doing 0 to 10%, many of these are very big issuers, and these are very big numbers. But interesting to see that there are a group now of issuers who are allocating 20% or more to ESG or GSS issuance over the course of 2023. This is a big market, albeit developing in different ways, as we'll see in a second. Next slide, please. Advanced economies are prioritizing green bonds, but it seems emerging market issuers looking at different markets. So green bonds are core to 65-ish% of developed market issuers, but actually big interest from developing economies in social bonds, sustainable bonds, and sustainability-linked bonds. And I'm sure our investors joining us on the conversation today will have some views about why that would be and what they're looking for. But the clear disparity there between developed market issuers and emerging market issuers. Next slide, please. So obviously one of the big innovations that we saw last year was sustainability-linked bonds and coupons that step up or step down depending on reaching certain KPI targets. And we saw Uruguay, and I think Chile as well, coming to the market with structures like that. Clearly, the jury is still out on this. There's probably more education that needs to be done, more learning, maybe to see how the deals already come into the market have performed. But this will obviously be a topic of debate, I think, in sessions like this for some time. There's a lot of interest, albeit not much of a consensus yet on exactly whether SLBs will become a core part of funding programs. And next slide, please. For all issuers, the issue of ESG ratings and communications around ESG and GSS are becoming firmly embedded in investor relations. We can see this in both advanced and developing economies. Developing economies slightly higher, but clearly ESG ratings are becoming more and more important, and discussion thereof between issuers and their investors. And next slide, please. Just a quick overview of where we come from in terms of 2020-22 activity. Compared to 2021 activity, markets were down in terms of volumes last year quite considerably in most areas. Start of this year suggests that numbers will be up this year. We shall see. So I hope you found all of that very interesting. As I say, please do download the report. You can see these charts and others as well in more detail. But to conclude, there are challenging market conditions that are prompting borrowers to revise issuance schedules and approaches to investor relations. Issuers are considering ways to deepen their relationships and offer more incentives to primary dealers in view of liquidity concerns. And as ESG ratings grow in significance, public sector borrowers will continue to drive the development of the GSS bond markets.